You were looking at a stock that was, I mean, it was once hailed as the absolute future of food.
Oh, totally.
Right, like it was supposed to revolutionize supermarket aisles, fundamentally change our diets, and frankly, just rewrite the entire consumer packaged goods industry.
Yeah, the expectations were astronomical.
Exactly. But today it is fighting for its basic survival on the Nasdaq. And I am talking about Beyond Meat, ticker symbol BYND.
It's quite the fall from grace.
It really is.
Yeah.
So the question we are asking you today is this.
Yeah.
Is Beyond Meat just a falling knife that's going to keep cutting whoever tries to catch it, like a textbook value trap?
Right.
Or is this, a wildly misunderstood, undervalued opportunity sitting on a powder keg primed for a massive, violent short squeeze?
That is exactly the tension we are examining today. The whole goal of this deep dive is to aggressively cut through all that noise.
Because there is a lot of noise.
So much noise. So we are breaking down the latest real-time market data, the contradictory technical signals flashing on the charts, and the very harsh realities of the company's balance sheet.
Which we really need to get into.
Absolutely. We're doing this to give you the complete picture of what is actually happening with the stock right now, beneath all the mainstream headlines.
Yeah, and before we get into the weeds, I want to explicitly remind you that this is an intellectual exploration.
Yes, very important.
We are looking at the raw data and debating the mechanics behind it. Absolutely no financial advice is being given here. This is pure analysis.
Strictly educational.
Right. And, hey, if you enjoyed this kind of raw analysis, please like the video, subscribe to the YouTube channel, and leave your feedback in the comments. Your engagement is what literally drives these deep dives.
It really does. And, well, that analysis has to start with acknowledging the sheer scale of the value destruction here.
Oh, it's massive.
Because to understand the current highly speculative price action, you really have to establish just how far this equity has fallen.
Okay, let's unpack this, because the current data is just, it's staggering.
It's hard to look at.
We are looking at real-time market quotes as of April 17th, 2026. The stock is sitting at a mere 0.78 and $82.
Less than 78 cents.
Less than 78 cents. Now, contrast that with the 52-week range. The high over the past year was $7.69, which, by the way, is already a shadow of its historical highs.
Right.
And the crushing 52-week low is exactly 50 cents. The market cap is completely evaporated, shrinking to roughly $363.4 million.
Yeah, and the dichotomy between the long-term structural reality and the short-term noise is, it's fascinating right now.
How so?
Well, the macro trend is undeniably severely bearish. I mean, it's a multi-year descending channel.
Right.
However, right now we're seeing this curious, very localized, neutral to slightly bullish recovery taking shape.
I mean the recent price action.
Exactly. That 78-cent price tag actually reflects a recent 4.11% daily bump.
Right. And that 4.11% bump is what's lighting up the retail scanners everywhere.
Yeah.
But looking at the broader trajectory, I can't help but compare this to, like, a blockbuster movie franchise.
Oh, that's a good comparison.
You start with this massive theatrical release, huge hype, everyone's talking about it, and now it's been relegated to those weird late-night infomercials.
Yeah, the 2 a.m. slots.
Exactly. So looking at this short-term daily bump, I have to ask, is this a real comeback or just a dead cat bounce?
It's highly probable it's just a bounce. I mean, to validate whether a short-term price movement has any actual structural integrity, you can't just look at the tape.
Right, you have to dig deeper.
You have to strip away the stock price entirely and look at the underlying operational fundamentals. A stock doesn't bleed out like this in a vacuum.
No, it doesn't.
We have to look at why institutional capital violently repriced this business model in the first place.
And to do that, we have to transition to the financials and look at the full year 2025 annual data. Because the reality here is it's incredibly hard.
Brutal, even.
Total revenue for 2025 has shrunk to $275.5 million. That is a 15.6% year-over-year contraction.
That's a massive drop.
They aren't just failing to grow, right? They are actively losing market share. But even worse than the top-line erosion is the gross profit.
This is the crazy part.
It plummeted 81.7% down to a razor-thin $7.6 million. That leaves them with a gross margin of just 2.8%.
Yeah, let's pause on that 2.8% gross margin because that is the central failure point of the entire enterprise right now.
Yeah, walk us through why that's so catastrophic.
Well, in the consumer packaged goods sector, standard operating margins need to sit somewhere between 30 and 40% just to absorb logistics, marketing, corporate overhead, all of that.
Right.
A 2.8% gross margin means their cost of goods sold is virtually eating every single dollar of revenue before it even leaves the factory floor.
That's insane.
They have zero pricing power against inflation, and they are clearly suffering from massive underutilization of their production facilities.
Which perfectly explains the operating losses. I mean, once you factor in those SG&A expenses and R&D, their operating losses balloon to $233.3 million.
It's a huge hole to dig out of.
They're hemorrhaging cash, just trying to keep the lights on, and then the product on the supermarket shelf.
Exactly. And what's fascinating here is that this operational cash bleed brings us to the most dangerous element on the balance sheet.
The debt elephant.
Yes, the debt load. The company is currently suffocating under approximately $1.2 billion in debt.
Wow.
For a company with a market cap of around $360 million, that enterprise value is totally disjointed from the equity value.
Completely detached.
The debt is at a critical existential level, while their total cash runway from the most recent quarter has dwindled down to a mere $203.9 million.
Okay, hang on though, because as I'm analyzing the 2025 income statement here, there is a glaring, almost absurd contradiction in the data.
The net income.
Yes. We just outlined a $233 million operating loss, yet the official filing shows a positive net income of $178.0 million for the full year.
It looks like a mistake, right?
I mean, the math on that is physically impossible from an operational standpoint. Is this like claiming you made money because you found a crisp $100 bill on the sidewalk while your actual house is actively burning to the ground behind you?
That is a phenomenal analogy, and it hits the exact mechanism at play here. That $178 million positive net income is an accounting mirage.
An illusion.
Exactly. When a company's bonds are trading at steep discounts, usually because the credit markets are pricing in a high probability of default, management can sometimes negotiate to retire that debt for pennies on the dollar.
Okay.
Under GAAP accounting rules, the extinguishment of that debt at a discount actually must be recorded as a gain on the income statement.
Wait, so they wipe away a liability and it magically appears as income, even though no actual cash entered the building?
Precisely. It fundamentally skews the net income line. It is vital to recognize that this was not capital generated by selling more plant-based burgers.
Right, it's just a paper maneuver.
Exactly. Operationally, the core business model remains severely distressed and continues to burn through that remaining $200 million cash pile at an alarming velocity.
Wow. I mean, if you aren't digging into the footnotes, a retail investor could run a screener, see positive net income, and think, oh, the turnaround is already happening.
It happens all the time.
But with fundamentals, this toxic traditional value investors aren't touching this, which means this recent price action is entirely a technical and speculative battleground. Let's pivot to the chart and look at the order flow.
It's the only logical next step, because when the fundamental thesis breaks down, the stock becomes a purely psychological instrument traded on momentum and technical boundaries.
All right, let's analyze the indicators. The stock is currently trading below its 50-day and 200-day simple moving averages.
Which just confirms the structural bearish dominance we discussed earlier.
Right. But it just crossed above the 5-day moving average of 79 cents, showing that localized burst of strength. But here is the technical contradiction I really want you to weigh in on.
Okay, let's hear it.
We've got an RSI pushing 77.6 on the daily. It's firmly in overbought territory, suggesting a near-term pullback.
True.
Yet the MCD is at 0.039 and flashing a buy signal. How are retail traders supposed to interpret a chart that is essentially screaming overbought and buy at the exact same time?
You navigate it by zooming out from the oscillators and looking at the structural liquidity and key price levels.
So ignoring the noise.
Mostly, yeah. Oscillators like RSI and MCD tend to break down during highly speculative, low-float retail manias. The MCD is just a lagging trend follower, confirming that recent volume has aggressively skewed bullish.
And the RSI?
The RSI is a leading indicator warning that the velocity of that move is unsustainable without a pullback. Traders resolve this by ignoring those indicators and focusing entirely on the battle lines, the hard support and resistance zones.
So where are those battle lines drawn in the sand right now?
On the downside, there is minor support at 75 cents. If selling pressure breaks that level, the major structural support is down at 50 cents, which is that 52-week low.
And if it breaks 50 cents?
If it breaches 50 cents, the floor falls out, and it's uncharted, highly volatile downward territory.
Yikes. And on the upside.
On the upside, resistance sits at $2. But before it can even dream of testing $2, it faces a monumental, heavily defended resistance at the $1 mark.
Ah, that $1 mark is the real psychological heavyweight here, isn't it?
It is the single most important level on the board. The Nasdaq compliance rules dictate that a listed security must maintain a minimum bid price of $1.
Right, or they get delisted.
Exactly. If it fails to regain and hold that level, the company triggers the delisting process. So $1 isn't just resistance, it's a ceiling with immense regulatory gravity.
And most institutional funds can't even hold sub-dollar stocks anyway, right?
Exactly, which means crossing that line is a prerequisite for unlocking any serious capital. And right now, the entity trying to push it across that line isn't Wall Street. We recently saw volume spike to over 48 million shares traded.
Which is insane for this stock.
It is entirely speculative, momentum-driven retail volume.
So you have retail traders flooding in on a speculative whim. But what do the professionals and the company's own leadership think about the stock's true value?
Well, that debate is where the real risk premium lies. If we look at the analyst consensus, it paints a very clear picture.
It is incredibly bleak. I mean, the consensus rating across the major desks is a strong sell.
Unsurprising, given the financials.
The average price target they've modeled out is just 66 cents. The absolute highest, most wildly optimistic price target out there is a single dollar. And the downside target sits at 50 cents.
Wall Street's best-case scenario is literally just surviving Nasdaq compliance.
Exactly. Which brings us directly to the undervalued versus value trap debate.
This is a crucial point to understand.
Despite trading as a penny stock, analysts still overwhelmingly consider BYND overvalued. Why is that?
It's easy to look at a 78-cent stock that traded well into the triple digits a few years ago and suffer from price anchoring. You think, well, it's been beaten down so far, it must be cheap.
Right, feels like a bargain.
But you just have to look at the price-to-sales multiple to see the trap.
The PS ratio.
Yeah, the price-to-sales ratio is 1.6x. When you compare that to standard, profitable, packaged food producers, they usually trade around 0.7x.
Oh, wow. So it's still trading at a huge premium to the industry average.
It is a textbook value trap. You are paying more than double the industry average for a company whose top line is contracting by 15%.
That is brutal math. And if we want to know how irrational it really is, we just have to look at what the people steering the ship are doing with their own equity.
Insider selling.
The insider activity data is just the ultimate negative signal. The chief financial officer, Lubi Kutua, sold 419,042 shares at roughly 60 cents on April 13, 2026.
That's a massive offload.
Plus, CEO Ethan Brown and Chief Operating Officer Jonathan Nelson executed sell-to-cover tax transactions back in March. I mean, when the guy managing the $1.2 billion debt pile unloads over 400,000 shares at 60 cents, it speaks volumes about their internal confidence, right?
It is the ultimate negative divergence. You can't ignore the optics or the implications of the CFO hitting the bid at 60 cents.
No, you really can't.
The CFO has total visibility into the real-time cash burn and the upcoming quarterly metrics. When an insider with that level of asymmetric information decides that 60 cents is a better exit point than holding for a recovery, the market takes that as a profound vote of no confidence.
So we have insiders running for the exits, analysts screaming strong sell, and a balance sheet that looks like a war zone.
Not a pretty picture.
We really need to weigh the ultimate downside risks against the one wildcard scenario that is keeping the stock alive. Let's map out the two distinct paths here. Give us the unvarnished bear case first.
The bearish continuation is rooted in the inescapable math of their cash runway. First, you have the persistent revenue contraction.
Right.
If consumers continue to reject premium-priced plant-based meats, whether due to inflation or a shift in diet trends, that top line just keeps bleeding.
Fading momentum.
Second, the long-term investors abandon ship. But the true death spiral mechanism and why retail traders constantly get trapped in these plays is the mechanical reality of avoiding delisting.
The reverse split.
Exactly. As that cash evaporates, management will be forced to initiate a reverse stock split to artificially inflate the share price back over $1.
And a reverse split is basically blood in the water for short sellers.
Oh, absolutely.
It does absolutely nothing to fix the underlying enterprise. In fact, trading algorithms usually target reverse splits, right? They immediately short the newly consolidated float.
Because they know the company is still functionally distressed. A reverse split is a desperate compliance maneuver.
It's a Band-Aid on a bullet wound.
Yeah. If they execute a reverse split and still can't stop the operational cash bleed, the worst-case scenario is an eventual restructuring or bankruptcy filing. The downside risk here is a total 100% loss of shareholder value.
Okay, that is a terrifying path. But here's where it gets really interesting.
The bull case.
Yes, the bull case. Let's present the best-case recovery scenario. Some point to the launch of the 4th-gen burger as a potential sales stabilizer.
Sure, product innovation helps.
But let's be intellectually honest. The real bull case driving that crazy volume is the staggering 33.9% short interest. Can you explain how this creates the perfect powder keg for a violent short squeeze?
With over a third of the float currently sold short, the days-to-cover ratio is putting massive pressure on those short sellers.
They are completely exposed.
If management pulls a rabbit out of the hat, say they announce an unexpected financing lifeline or a strategic partnership, the stock price violently ticks up.
And then the trap snaps shut.
Exactly. Those shorts are suddenly caught in a margin nightmare. They're forced to panic buy the stock at market price to close their positions, which drives the price even higher, triggering the next wave of margin calls.
It becomes an algorithmic feedback loop.
Pure market mechanics. When short interest exceeds 30%, the stock completely detaches from its fundamentals. Positive news just weaponizes the existing short positions against themselves.
So keeping all of this in mind, the massive debt, shrinking demand, insider sales, but also this squeeze potential, what's the final short-term versus long-term outlook here?
The long-term perspective is profoundly clouded. You have a distressed balance sheet and shrinking demand. From an investment standpoint, it is a highly dangerous play.
A radioactive asset.
But the short-term perspective offers extreme volatility and the undeniable potential for a speculative squeeze.
So what's the catalyst we need to watch?
The Q1 2026 earnings report expected around May 13, 2026. This will be the ultimate test. Institutional desks will be hyper-focused on the auditor's notes, specifically looking for a going concern warning.
Wow. Meaning the auditors doubt they can stay solvent for the next 12 months.
Exactly. That May 13th date is the defining inflection point.
And that brings us to the final provocative thought for you to ponder. If a pioneering company that fundamentally changed supermarket aisles and consumer diets can find itself fighting for pennies and facing delisting, what does this mean for the future of the entire disruptive food tech industry?
It's a huge question.
Are we witnessing the death of the plant-based revolution, or just a painful pruning before its next evolution? We'll leave you to chew on that cliffhanger.
No pun intended.
Right. Please leave your thoughts on that in the YouTube comments below. Make sure you like and subscribe, and we will see you on the next deep dive.